Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, May 15th, 2024, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at a little bit of a yin and yang situation here. I want to talk a little bit about what I consider a much more conservative play, covered calls, and then the meme stocks sure came roaring back this week with the reappearance of Roaring Kitty, who has been absent from the internet for about 2 years, I believe. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/Sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. Finally, this is available in an audio-only format wherever you get your podcasts. If you can't find it there, let us know and we will get it there. But let's hop to this week's episode. Viper, this week, the meme stocks came back. I started driving into work on Monday, and people were kind of chattering a little bit about some tweet. I think it was Monday or Sunday night that the tweet actually came out, which was just a graphic from Roaring Kitty's Twitter handle, I believe. And it wasn't long after that, and the markets opened, and GameStop was off to the races. I didn't keep too close of tabs on that, but I understand that GameStop kind of took off, and the stalwart AMC also joined in with the fun.
Yeah, it did. I had seen the tweet Sunday night. Like you said, that's when it came out, and it was just a picture that you saw there in the opening of just a gamer sitting in a chair and then leaning forward, kind of like, hey, pay attention. And yeah, that was all it took for pretty much the entire Twitterverse to explode with speculation of what was happening. Obviously, Roaring Kitty, infamous for the GameStop situation last time around, the entire movie that was made about it, called Dumb Money, which is actually a really good movie. I enjoyed it. But I watched it recently, having forgot about it for a long time. So it certainly caught my attention because the movie and everything was still fresh on my mind. But I still didn't take super close attention. I was like, oh, okay, that's cool. I didn't even realize he was gone for those 2 years, but saw him come back, and I was like, oh, that's neat, and just forgot about it. But yeah, Monday morning, doing my morning chores, and one of the other Discord Blockhead traders pinged about, hey, IV is going off the charts, obviously for GameStop, but also AMC. But the underlying AMC ticker stock itself was only up at that point about 10 or 15%. So IV was exploding, but the price had not yet driven up just yet. So I hopped on and messed around a little bit with it.
So were you buying options? Were you buying shares? Were you selling options?
So I jumped on and decided, I mean, it was all a very rash split decision of like, all right, so I did not even look at GameStop because obviously I just knew in the back of my mind, obviously knowing the environment, I'm not even going to touch that. I'm not going to look at it. It's too late. It's pretty much too late the moment you see it, sort of thing. So I didn't even consider GameStop, but for AMC, when I saw that the price was, like I said, up only 10 or 15%, I had very little, and this is interesting because this will actually touch on very legitimate use cases for options, but I jumped on to my Robinhood account because that's usually where most of my just kind of, jump on opportunities type of money is sitting, and I didn't have a lot of free cash freed up in that account. So buying shares wasn't really a choice because one, I didn't like the potential, dud if it didn't hold. It was already up 10 or 15%. I didn't want to catch that retrace. So I jumped straight to call options, buying call options. And at the time that I looked at it, they were selling for around 45 cents a piece, which is $45, obviously. So given the very, very limited capital I had in my account, I said, hey, $45 a pop. Like, let's fire a few of these off and let's just see what happens. And so that was my exposure, was grabbing a few of those. And, also just the nature of these things. It seems like I know that buying call options is not usually your thing naked anyways, or if that's if it, I mean, you sell naked, I don't know, whatever the equivalent is for buying, because you take that initial hit up front. So, those $45 a pop, I'm never seeing that money again. Regardless, if it doesn't, if the contract expires worthless, I'm never seeing that. So I took that hit up front, but that was part of the somewhat calculated bet of, if this thing's going to run today, um, that's capital efficiency of getting exposure to 100 shares per contract at $45 a piece. So that was the play that I
Yeah.
made.
Let's talk a little bit about the mechanics of that, because there is an interesting phenomenon that does occur with options, and one of the reasons I do think it's, I personally don't buy call options, and it's really because your premium that you're purchasing does decay away. And if I actually buy them, I usually buy them when they're deep in the money, so I'm not really paying a lot of that extrinsic value or that premium value. But the mechanics of what you did, so I think you said a $4 strike that you bought. I'm going to guess that the underlying was not trading above $4 at the time that you bought those calls. I'm going to guess it was, $2 or $3. Is that true? Okay.
Yep. Yeah. It was the underlying, when I bought it, underlying was at $2.50, because I remember looking at it like, all right, I mean, $4, that's pretty far away from where we're at. But, and I even made the comment in Discord, hey, here's what I did. I bought these calls, and I even made the comment, I'm probably going to get rocked on theta decay here because I bought Friday expiration. I didn't really, like I said, I don't normally do this, so I didn't plan out like, oh, I should go for the monthly, or I just went, oh, end of the week, like, boom, let's do that. So yeah, so it was $2.50 underlying, and I was fully expecting $4 strike is far enough away that theta is going to eat me alive.
Yeah. So here's what's interesting that happens, and this is why when you're kind of expecting a very, very fast moving event to really extend huge price swings, you can really make out big on options. So it's important to understand, hey, you probably could kiss most of that goodbye if you don't get the move that you're looking for. But what will happen as you approach that at the money strike, that $4, you'll your value of that option will go up incrementally because you're going to attach more premium because you're getting closer and closer to the money. But where it's really going to start to take off is when you pass your strike. And the reason is because your option contract is going to represent 100 shares. So if you go 50 cents past that strike, the option price has an intrinsic value. You cannot take that away, of 50 cents a share. And so when you represent 100 shares, that's $50. And if you go $1 above that strike, it's $1 times 100 shares, because yes, you only paid, $42 or $45 to buy that option. But once you cross that strike, where you make a lot of money is all of that intrinsic value the further that thing runs. And so I think AMC topped out maybe around $7 or $8 on that trading day. And so, that was double your strike price. And so the inherent value of that one option contract would have been, $700 or $800. Now, it would have been a little bit more than that because you still have time left on it, but that time is going to be dwarfed by the intrinsic value the further you cross that strike. That's why a lot of these meme stocks have all of this call skew and people are buying the options, because when you purchase it out of the money, like you did, Viper, it's trading at 250, you purchased a $4, the option price hadn't gotten to your strike, and so you're just paying for that premium. And yes, that's expensive on a relative basis, but as soon as you cross that strike, the amount of leverage that you have, where that $45 is controlling 100 shares of stock, is really where you can, crush that on a percentage return. So your $50 could have turned into, 800, 900. And that's a big X on your initial payment.
Yeah, yeah, exactly. And so the way it's played out so far, fairly proud of myself for, just understanding the mechanics of what was happening under the hood. So, like being able to strike quickly, like I said, in a matter of minutes less, I knew here's how much money's in my account. Here's what I'm able to do with that. Let's go, because time is of the essence at this point in time. And so jumped in, did that. And then, yeah, like you said, it rocketed throughout the day. So we get to the end of the day, closing. It was like 3:45, 3:50 in the afternoon, just before the closing bell. And I went and I logged in and I looked and I was like, oh, sweet. Like those contracts that I bought for 50 cents, whatever, had now, so I bought three of them. And so the price of them had tripled. And so I was like, sweet, I can sell one of these right now before the closing bell, because the options are not traded after hours. So I was like, let's do that. We'll close it. Now my account is made whole and nothing has changed in that regard. And I still have two of these things open, in case that, things get a little crazy in the future before expiration. So they did get crazy on open Tuesday morning, but I did not sell them. I still have them. And again, this is all because I'm on the speculative, like what's going to happen. And most importantly, I've already mitigated my loss by getting my loss back, which was key and paramount in all of this. That, most likely based on action today, most likely I'm going to sell these things, close it out tomorrow while there's still a decent amount of money on them, unless things get more volatile again. Because like you said, time is working against me, even though I did not capitalize when it was super juiced up, because I wasn't quite thinking through the intrinsic, or the effect of all of the different things, and realizing how rare of a moment that was Tuesday morning when the bell opened and it caught all that volatility. But at this point, pretty set. I mean, unless it opens up tomorrow at like below $4, it closed at $5. So I mean, stranger things have happened, but after hours it's holding $5. So as long as it doesn't open up before $4, below $4 tomorrow, my plan is to probably ring the register on this and call it a win.
Yep. On the flip side, Viper, I, of course, have gone the complete opposite direction of your meme stock environment. And I have been engaged in my favorite activity of premium selling. And I wanted to kind of touch just a little bit on the covered call today. And the reason I wanted to touch on it is because I've been rolling a particular position. It's something I got assigned in Dollar General, and we've talked about it. And I just decided, you know what, I want to take a look back, because I ended up selling out another monthly covered call on it and collected another, $426. And this is I don't know what consecutive month. We'll be able to count them here in a second when I flip over there. And I thought, this is a very beginner comfort trade, in my opinion. I think way back when we first kind of talked about covered calls a few times, I said, if you've never really messed with options and you want to learn, a covered call is one of the best and safest methods to do it. And so what that effectively is you will have 100 shares of something. Okay. So in this case, let's say Dollar General, which I had. And every option contract represents 100 shares. So if you sell a call against those shares, it basically means you are giving the person that buys the call the right, but not the obligation to call those shares away from you. So you're telling them, hey, if in Viper's case, he bought a $4 call. So he was the one that held the right of AMC to go, and he could have turned that coupon in and said, you know what, sell me your shares, 100 of them for $4 when it was trading at $8. And that person would have to sell those shares to him for $4 a share. Now, if that person didn't have those shares, he has to go to the open market and buy them at whatever they're trading at. So if they're trading at, $8 a share, he's got to go spend $8,000 to give Viper 100 shares at $4 a share. So Viper's going to spend $4,000, but that guy who sold the call has to spend $8,000 to do it because he didn't have the shares. Now, a covered call is basically that same transaction, but the guy that sold the call owns the 100 shares, right? So he doesn't have to go to the open market. He just pulls out his shares and says, okay, here, I'll sell you these for $4 like I promised you. So maybe he bought AMC at, $1 a share. So maybe his 100 shares only cost him $100. So if he has to sell them at $4, I guess that would be 400, at $4 a share for 100 shares, then, he still made money. So what I wanted to do, and I'll flip over here to the screen of this covered call that I've had going with Dollar General. And so I'll show you on a chart here in a minute. But what I want to call out is I entered this thing on an earnings trade back in the end of August in 23. So I've had this thing for a long time. It went against me. I actually got assigned the 100 shares of Dollar General, and I have been wheeling this thing since then. And wheeling basically just means selling covered calls as soon as I can. And just recently I rolled out to I didn't go to the next monthly because Dollar General actually has earnings on May 31st. And so that particular week has extremely high volatility. And so my current covered call was actually expiring on the 17th of May, this Friday. There was almost no value left in it. So I went ahead and closed it out for about $5 or something like that, 5 cents. And I sold this call in May 31st for $426. But what I want to call out here is over the course of this trade that's lasted about 9 months, I have collected between dividends, because I own the shares. So every time they pay a dividend, I get the dividend, and the covered calls, I've collected $26.18. That's $2,618 over the course of 9 months. Now, yes, it has consumed $10,000 in buying power, but if you do the math, that's a 26% return on capital. And if you divide that out by 9 months, it's effectively a 3% return every month on my cash. So this is where I say this is a very conservative thing to do, because I simply just sell the call, sell the call, sell the call. And I do that each month. And it's basically like getting a small check, a small dividend check from that. Now, I also get real dividend checks because I own the shares. But I want to kind of call that out to show that repetition. And you might think, well, okay, Sprocket, you got lucky because you haven't really got assigned the stock. And truth be told, what I've really learned about option trading is the chances of you getting assigned early are pretty stinking small. I mean, can it happen? Yes. But here, let's look at the chart here, because I actually pulled up or I marked out where I got assigned, how low I was. I mean, this was a really, really ugly play. I mean, we got down to almost $100. The strike that I got assigned at was $145 for these shares. So significantly in the hole. But what I wanted to call out here is these blue boxes are where I had covered calls in play. So we had a big run up back here in December. I got a covered call out there for a month. It fell off. Volatility fell off. It wasn't that profitable. So I didn't start another covered call till probably closer to the end of December. And this was the beginning of December. But look at this. Do you see this big charting up here in the blue? This was all in the money. Like, I could have been early assigned in here because that option was in the money. And so, yeah, I could have sold my shares and my call, but I said, I'm in this for the longer term. I'm going to hang on to it. And I just kept rolling in there, collecting more premium. And then sure enough, the price kind of traced back down and we fell out of there. Now I'm actually out of the money, but I'm still selling these calls up here at the 145 strike. And now I'm going out here to May 31st. And there's a lot of power in this because if you are the type of person who's not comfortable trading options, but you have a portfolio full of shares, you can look at those shares and you can go out and you can sell these calls, which, yes, you're going to have an obligation to sell your shares, if somebody calls them away from you. But as long as your strike price is above your cost basis, you're still going to make money. So, my strike was at 145. And so the calls that I've been selling is at $145. But if you factor in all the premium that I've sold on this thing, you can basically subtract $26.18 away from that 145. And my cost basis is really, around $120. So, just think about that because I'll just keep selling this. And the more premium I sell, the lower and lower that cost basis gets.
Yeah, I would piggyback on that. Of my other favorite way to initially expose yourself to options would be what you could potentially do before getting to the covered call, which is you need to acquire those 100 shares. And that would be selling a naked put. And so this is, let's say slightly more risk because you have to buy them. But I think it's a similar risk to the covered call because essentially, at this point, if you're experimenting, thinking about getting involved with options, you know what a limit order is. And obviously you would, if you want to buy shares and you're trying to do it methodically and as smart as possible, you're not just going to jump in and market buy 100 shares of something. You're going to scope out a chart, find a price that you want to pay, and most likely that price is less than where the price is now. And you would go in there and you would put in a limit order and say, hey, for Dollar General, I want to pay $1.50 or $115 for 100 shares. I mean, that's a pretty large position. So let's say it's a $10 stock. And you say, I want to buy 100 shares at $8, but current price is 10. So I'm just going to wait. The naked put is the same exact concept as a limit order, except it's a one contract and it's a bundle of 100 shares. So you have to do that math and make sure that you're that sized position falls into all of the other rules and whatnot. But assuming it does, then you just sell that naked put at $8. You collect that premium up front. That premium is yours forever. Do whatever you want with it. You've collected it. It goes in your pocket. And now you either get to the expiration of the contract that you sold and price is at or below your strike. Congratulations. You've hit your limit order. You now have 100 shares or 100 times however many contracts you sold. Plus you took extra money from selling that contract. So in the exact reverse scenario of what Sprocket just laid out, you sell $8, it never happens. The thing expires worthless. Well, guess what? You collected 15 cents. You collected $15 on that. So now you have $15 more and you just do it again and you do it again. And all of a sudden you're collecting money waiting for a limit order to hit. That feels pretty good. Feels pretty multidimensional. And then eventually maybe it hits and now you have your shares and you just flip it around and start doing the covered call.
Yep. That's definitely, I don't know. It's the way I love to trade. It's the thing that I like to hit up. A lot of times when I enter stocks, that's how I enter them. I just sell puts. And if I get assigned, I get assigned. Great, wonderful. I wanted to own the shares. If I don't, you know what? I collected some premium. Go look for something else. And this is a mode that I've really kind of flipped into since last summer. I started originally in it. I drifted and I kind of came back to it. And I've been really, really happy with my results since. I keep them all posted up on thetagang.com. And I bring that up only because, Viper, I don't know that I told you this yet, but I'm not really sure what the metric is that they use, but they rank all the traders on ThetaGang now. So when you look up somebody's profile, it gives you a rank. And I am in the top 1% according to the statistics on there. I'm actually ranked, I believe, 87 as far as the number. I don't know if it's the number of trades or the consistency or what have you. I don't think it's money collected. I think it's just the amount of trades relative to the other participants on the platform. But I thought that was kind of cool. I have a little like badge now with a little ranking thing, and yeah, it's kind of neat.
Yeah, Mr. 1%er. We got a big
That's
wig
right.
now on the show.
I think I was told that I'm 500 points away from the diamond tier. I'm currently in the platinum tier, but the diamond tier is the highest tier that they have. Like I said, I'm not really sure what the metric is. It's probably number of trades or consecutive trades or something to that effect. But that's kind of neat.
I mean, I also see that you have the Ember Spirit achievement, whatever that means.
Yeah.
So
no, I did.
go.
I actually claimed that when I looked, and I was so frustrated because the Ember Spirit, and I can't remember what the next one is, but it goes by how many repeating days that you go to the site. And I'm trying very diligently to do it, and I think you had to go 100 days sequentially to get that one. And I think I made it to like 156, and I don't like it because they count weekends, and I think I was like at a baseball game or a soccer game or something like that, and I didn't go to the site to go into my account, and I lost my streak, and now I'm building back up. I think I'm at like 11. It's going to take me half a year to get back there now. All right, that brings us to the end of this week's episode. Whether or not you prefer the fast and volatile meme stock mania, where you can swing up 70% and swing down 70% all in the same day, or if you prefer more of a slow and steady trickle in kind of dividend payment, monthly income type approach with the selling covered calls, just again and again and month after month. I hope you can find the style that's right for you. I know personally when I started doing the covered calls and even the naked puts for that matter, I thought, oh my gosh, I'm in the money. I'm going to get assigned. I'm going to get assigned. And then I like wait and I wait and I wait and nothing. I'm like, well, I guess I'll roll it, and I'll roll it forward a month, and I never get early assigned. I have just been really, I'll say, impressed or surprised at how deep in the money you can get on these things, and people just don't do early assignment because it's just not that beneficial for them to bow out early. You might as well take it up to expiration. And so in the chart that I showed you, I was selling a 145 call in Dollar General. Dollar General traded up to $170, $30 in the money, and I was not early assigned. And I was able to roll forward and collect more premium. And so I've learned to be very patient and just hold on, even though it looks like, oh my gosh, you're going to get assigned. And on the put side, which is the exact opposite, you can be deep in the money and not be assigned on the put side. And you can just roll again and collect more premium. And I do that actually to force the other party to early assign me. So look, if you're not going to early assign me and I still got 3 days to expiration, I'm going to roll forward, collect more premium. And then if you early assign me, before, okay, well, at least I got my more premium in. So it's all that kind of limit order basis that Viper really talked about. So find your own trading style. Mine is clearly not the meme stock mania, although there are plenty of meme stock fans in the Blockhead Traders Discord. So don't think that everybody in there is the fuddy-duddy conservative guy like me. They actually do a lot more exciting things than myself. I just occasionally chime in. Yep, sold some more premium, guys. And they're like, that's cute, buddy. You keep going. But it's a good place, so I encourage you to stop in and say hello. Good luck out there finding trades that excite you, and hopefully you're picking up winners and ringing the register and not getting too greedy. So good luck, and remember, think outside the block.